January 2022. Headlines blared a 40-year high as CPI inflation hit 7.5%. But for students of central banking history, a deeper, more chilling parallel emerged. The last time America witnessed such a violent price surge was not in the 1970s, but in 1920. And the Federal Reserve AS response a century ago remains one of the most brutally effective and devastating in its history. The data reveals an eerie mirror. Post-World War I, a mix of massive fiscal demobilization, broken global supply chains, the Fed's initial reaction was also parallel. In 1919, as in 2021, the board was hesitant, fearing it would cripple a fragile economic recovery from a global catastrophe. Then, under intense political and public pressure to do something, it pivoted to aggressive action. The period from 1920 to 1923 created a stark disinflationary playbook, studied by every subsequent Fed chair, including Jerome Powell. This raises the critical modern question. The 1923 playbook worked, but it triggered a severe depression and unemployment nearing 12%. Why is the 2024-2026 Fed deliberately rewriting that script? And what does this fundamental deviation mean for the economy, markets, and your finances in 2026? To understand this fork in the road, we must first go back and examine the original brutal policy script written in gold and deflation 100 years ago. Faced with runaway prices in 1920, the early Federal Reserve executed a policy of breathtaking austerity, rooted in the liquidationist economic theory of the era. Led by the powerful New York Fed President Benjamin Strong, the system did not gently tap the brakes, it slammed them through the floor. The primary policy tool, the discount rate, was jacked from 4% to a punishing 7% within a single year. The goal was not to fine-tune a soft landing, but to forcibly purge the financial system of what policymakers deemed speculative excess and inflationary tissue. The intellectual rationale was starkly articulated by Treasury Secretary Andrew Mellon, who advised President Harding to liquidate labor, liquidate stocks, liquidate the farmers, purge the rottenness out of the system. The Fed's mandate was to defend the gold standard. Human suffering was seen as a necessary, if regrettable, side effect of restoring monetary integrity. The result was a deflationary hurricane. The wholesale price index collapsed over 40% in just 18 months. Industrial production plummeted nearly 30%. Unemployment skyrocketed to an estimated 12,015%, plunging the economy into the forgotten depression of 1921. The economic carnage was severe and widespread, devastating farmers, factories, and workers. Yet, from the Fed's perspective, this brutal medicine worked with terrifying efficiency. The depression, while sharp, was remarkably short. By late 1922, prices stabilized, the gold standard was secure, and the foundation was laid for the subsequent Roaring Twenties boom. The episode crystallized into the 1923 playbook, the belief that a short, decisive, and severe monetary shock was the most effective cure for post-crisis inflation, worth the immediate economic wreckage. It was a success defined by price stability alone, achieved through deliberate, accepted economic contraction. For a century, this episode haunted the halls of the Eccles Building. It stood as the ultimate test of central bank resolve. When inflation reawoke in 2021, a critical question hung in the air. Would Chair Jerome Powell, a student of history, follow Benjamin Strong's austere playbook? The answer would define the next decade. The brutal 1921 playbook was executable only because of a hidden foundational condition, a comparatively low-debt economy. In 1921, total U.S. debt to GDP stood at an estimated 150–160%. When the Fed hiked rates to 7%, businesses failed, banks closed, and assets were liquidated. The system, while suffering acute pain, could absorb these losses without triggering a complete domino collapse of the financial structure. Contrast this with 2024. The economy is a meticulously calibrated, highly leveraged machine. Total debt to GDP exceeds 350%. Non-financial corporate debt alone approaches 80% of GDP, much of it refinanced at low rates during the 2010s. Applying a 1921-style 7% policy rate would not just slow the economy, it would detonate immediate cascading defaults across commercial real estate, leveraged corporations, and strained government budgets. The transmission mechanism of policy has been fundamentally altered by decades of financialization. This is the core insight of economist Hyman Minsky's financial instability hypothesis. The 1920s system largely operated in a hedge financing stage, where borrowers could cover debt payments from their cash flows. Today's system, in key sectors, is fundamentally speculative or Ponzi-like, reliant on constant refinancing and ever-rising asset prices to remain solvent. The modern Federal Reserve understands this existential constraint. Chair Powell and the FOMC's paramount fear is not 1920s-style liquidation, but a 2008-style systemic financial collapse. triggered by their own rate hikes. Their binding constraint is no longer the gold standard, but the mountain of debt itself. They cannot liquidate an economy that is, in essence, a complex web of liabilities. This single, monumental difference, the shift from a capital-based to a debt-saturated system, forced the Fed to abandon the old playbook and write a new, more dangerous, and utterly experimental one. Confronting inflation a century apart, the Federal Reserve's tactics reveal a philosophical chasm. The modern Fed has engaged in a high-wire act, the dovish hike experiment. While raising the federal funds rate at the fastest pace since the 1980s, its rhetoric and auxiliary tools have been meticulously designed to avoid the 1921 playbook's carnage. The contrast in communication is stark. The 1920s Fed spoke in the brutal dialect of liquidation, aiming to purge inflationary tissue. Chair Powell's FOMC, by contrast, has incessantly calibrated its language around data dependence, the goal of a soft landing and avoiding unnecessary hardship to households and businesses. This is not mere public relations. It is a critical policy tool. This forward guidance shield allows the highly leveraged financial system to adjust gradually, preventing the sudden, catastrophic margin calls and fire sales that a 1921-style shock would trigger. Every hike in 2022-2024 was telegraphed months in advance, a luxury Benjamin Strong's opaque Fed never afforded the markets. Furthermore, the Fed's battlefield has expanded. In the 1920s, its balance sheet was a trivial factor. Today, unwinding the nearly $9 trillion accumulated via quantitative easing, a process called quantitative tightening, QT, constitutes a silent second front in the inflation war. The Fed must shrink its holdings of treasuries and mortgage-backed securities with extreme caution, acutely aware that moving too fast could disrupt the plumbing of the $25 trillion treasury market, the bedrock of global finance. The usage of facilities like the overnight reverse repo on RRP acts as a release valve, a complexity unimaginable in 1921. This defines the critical deviation. The core of the 1923 playbook was a principled indifference to short-term economic pain, seen as a necessary cleanse. The core of the 2024 playbook is an all-consuming obsession with threading the needle, crushing inflation without triggering a hard landing or a financial crisis. This nuanced, communicative, and risk-averse approach is its greatest political strength. But it is also its greatest vulnerability. By seeking to avoid a clear, sharp recession, it risks a longer, grindier battle with inflation, where expectations could become unanchored. This fundamental deviation in method sets the stage for two entirely different economic destinies in 1926 and 2026. Beyond debt, a second unbridgeable chasm separates the eras, the political and social tolerance for economic pain. In 1921, the Federal Reserve operated in a social vacuum. There was no federal unemployment insurance, no significant social safety net, and its legal mandate was singularly focused on financial stability and the gold standard. The political pressure to preserve jobs was minimal. The Fed could and did ignore unemployment soaring to 12%, viewing it as a tragic but necessary byproduct of liquidating inflation. The modern Fed inhabits a different universe. Since 1977, it has operated under a formal dual mandate: maximum employment and price stability. Chair Powell faces blistering political pressure from all sides, criticized for hiking too slowly if inflation persists, and too quickly if jobs are lost. A 1921 level unemployment rate is not an economic statistic. It is a political impossibility that would trigger immediate, overwhelming congressional intervention. This is compounded by a different labor market dynamic. The 1920s Fed worried less about a wage price spiral, as union power had been weakened post-WWI. Today, while union density is lower, the labor market itself is structurally tighter, with an aging workforce and lower participation. Metrics like the Atlanta Fed Wage Growth Tracker show persistent wage increases, creating an inflationary pressure that is slow to recede. The Fed cannot simply crush demand through unemployment without triggering a social and political crisis. Consequently, the modern Fed is forced onto a tortuous middle path. It must raise rates enough to cool aggregate demand, but it is simultaneously and actively hoping for inflation to be tamed by improved supply chains, a phenomenon some economists call the Romer hypothesis for the 2020s. Its strategy relies on inflation falling partly through healing rather than solely through suffering. Crushing demand alone would require a level of unemployment that is now institutionally and politically untenable. So, if the Fed cannot administer the 1921 shock treatment and cannot tolerate 1921 level social pain, what is the logical yet uncertain endgame for 2026? The modern Fed's constrained playbook points not to a single destination, but a fork in the road for 2026. The pristine 1926 outcome, a roaring debt-free boom born of pure liquidation, is impossible. Our starting point is a mountain of debt, leading to two plausible yet problematic endgames. Scenario A, the long landing, stagnation. This is the higher probability path per many 2024 economic models. Inflation grinds down slowly, settling around 3%, above target but tolerable. Fearful of reigniting prices or snapping the fragile debt structure, the Fed keeps policy restrictive for longer than anyone hopes. The result is economic stagnation. GDP growth limps along at 0.1%, unemployment settles at an elevated 5-6%, and risk assets endure a grinding, volatile bear market. The economy in 2026 feels fragile, sluggish, and trapped in a low-growth equilibrium, unable to truly recover due to the persistent debt overhang and high cost of capital. It is a victory over hyperinflation, but a Pyrrhic one. Scenario B, the cycle, reflation. This is the institutional bet and the market's hope. Inflation falls convincingly to the 2 to 2.5% range by late 2025. True to its new reactive playbook, the Fed pivots swiftly, cutting rates aggressively to stave off recession. This reliquefies the financial system. However, with government deficits still large, this new liquidity floods not into productive investment, but into financial assets, reigniting asset price inflation in stocks, real estate, and private equity. 2026 could see a booming S&P 500 alongside a stagnant Main Street, a financial cycle boom superimposed on a weak business cycle. This boom is inherently fragile, built on even more debt, and dependent on perpetual central bank support. Why this is not 1926? The Roaring Twenties boom followed the 1921 depression because the liquidation created a clean slate. Debt was low, allowing a wave of private innovation, autos, radio, electrification to be financed with new credit. In 2026, we will begin with more debt than we had in 2022. There is no clean slate. Any boom will be built upon an already leveraged foundation, making it more speculative, more financialized, and more vulnerable to the next shock. The choice is no longer between bust and boom, but between two forms of instability: grinding stagnation or a volatile, debt-dependent financial reflation. This bifurcated future isn't just about economics. It strikes at the fundamental credibility of the institution steering the ship. The Fed's new playbook seeks to avoid past horrors, but in doing so, it may have charted a course for a novel set of perils. The aftermath of these divergent playbooks will redefine the Federal Reserve's institutional standing for a generation. The 1923 Playbook S legacy was paradoxical. It cemented the Fed's credibility as an inflation fighter, but fostered a dangerous blind spot toward asset bubbles and financial stability, a myopia that culminated in the 1929 crash. The 2024-2026 Playbook's legacy hangs in the balance, leading to two divergent futures for Fed credibility. If deemed successful, a soft landing, it will establish a new doctrine of constrained fine-tuning, the belief that the Fed can navigate between the Scylla of inflation and the Charybdis of debt-induced financial collapse. The Fed would be seen as omnipotent, its independence further solidified, and its toolkit of forward guidance and balance sheet management validated as the new orthodoxy. If deemed a failure, persistent stagflation, or a financial meltdown, the myth of Fed omnipotence will shatter. Credibility will evaporate as the public blames it for either enduring high prices or for causing a recession and job losses. This could trigger a severe political assault on its operational independence, with lawmakers demanding oversight, new mandates, or even a restructuring of the institution itself. The most insidious risk is a quiet failure. By 2026, after years of grinding above target inflation, the public and markets may simply lose faith in the 2% target, implicitly accepting 3 to 4% as the new normal. This would represent the ultimate defeat of the post-2020 policy experiment, not a dramatic collapse, but a slow, corrosive erosion of the Fed's primary anchor for economic decision-making. Thus, the Fed's current gambit is not merely to lower inflation, but to maintain its credibility across its entire dual mandate in a world where those goals are in severe tension. The lesson from 1923 isn't about the level of interest rates, it's about the profound limits of central banking in vastly different financial worlds. The Fed of the 2020s is discovering that its greatest constraint is not economic theory, but the legacy of its own past successes in fostering a debt-saturated system. By dissecting a century of policy, we can extract 4 core principles that govern central banking then and now. These principles explain why the Fed of 2024 could not and cannot follow the 1923 script. Principle 1. The central bank is a creature of its financial system. Its effective tools are dictated by the era's dominant assets and liabilities. In 1920, the anchor was gold, and policy worked through bank reserves and the discount window. In 2024, the system is built on treasury securities and mortgage-backed securities. Policy therefore works through manipulating their yields via a massive balance sheet and forward guidance, tools irrelevant in 1920. Principle 2. Political economy. Trump's pure economics. The Fed does not operate in a vacuum. Its actions are rigidly bounded by what is politically and socially tolerable. In 1921, mass unemployment was acceptable. Today, it is not. The Fed's dual mandate is a political reality as much as an economic one, forcing it to balance inflation, fighting against social stability. Principle 3, expectations are the new gold standard. The mechanical discipline of gold flows is gone. In its place, managing market and public inflation expectations has become the primary transmission mechanism of policy. A stated 2% target and forward guidance now perform the anchoring function that a gold peg once did. Losing control of expectations is the modern equivalent of a gold standard breakdown. Principle 4, there are no clean slates. High debt creates hysteresis. Past policy decisions, decades of deficits, quantitative easing, permanently alter the financial landscape and constrain future options. The Fed cannot liquidate because it is managing the very debt it helped create. Each cycle leaves the system more leveraged, not purged. This culminates in a modern paraphrase of Walter Bagehot's classic rule for a lender of last resort. The Fed must lend freely against good collateral at a high rate, but only if doing so does not trigger a cascade in the derivative markets and destabilize the sovereign debt itself. The complexity is the constraint. These 4 principles explain why, when you look at the economic charts, the eerie parallels between 1920 and 2022 break down decisively after 2023. The Fed embarked on a fundamentally different path, not by choice, but by necessity. The most relevant historical fear, therefore, is not 1921's depression, but the boom and bust that followed. The true parallel lies between 2024, 1926, and 1924 at 1929. After successfully crushing inflation in 1921, the Fed kept policy accommodative, focused on stabilizing the international gold standard. This environment of low rates and price stability fueled a historic, credit-driven stock market bubble while the Fed, believing its job was purely price and gold stability, stood idly by. It failed to see financial stability as its concern, a catastrophic blind spot. The 2026 risk mirrors this. If the Fed executes its soft landing and pivots to aggressive rate cuts in 2025, scenario B, reflation, it would be pouring gasoline on asset valuations already disconnected from economic fundamentals. The greatest danger for the late 2020s may not be resurgent inflation, but the incubator of a systemic financial bubble in a world still saturated with the debt the Fed sought to manage. The new playbook might deftly avoid 1921's mistake, only to meticulously set the stage for a 1929-style financial collapse. The key difference, again, is scale and complexity. In 1929, the bubble was concentrated in exchange-traded stocks bought on margin. Today, the bubble is omnipresent and interconnected in sovereign debt, private equity, commercial real estate, and speculative crypto and meme assets, all woven together by a vast, opaque, global shadow banking system of hedge funds, family offices, and levered ETFs. The contagion pathways are more numerous and faster. This presents the Fed with an agonizing, unanswered question. Having rewritten the 1923 inflation playbook out of necessity, will it also internalize the lesson of 1929 and actively use its regulatory and macroprudential tools to lean against financial excess? Or will its paralyzing fear of triggering a debt crisis by raising rates or tightening financial conditions keep it passively on the sidelines, monitoring the bubble until it pops? The Fed today is acutely aware of these risks. Its financial stability reports detail them, but this awareness may lead to policy paralysis, not prevention. This tension between the documented blindness of the 1920s Fed and the verified potentially paralyzing awareness of the 2020s Fed leads to a final, sobering conclusion for investors and citizens alike. We are not reliving the 1920s. We are navigating the first great inflation battle of the third Fed regime, the post-global financial crisis, high-debt, quantitative easing era. Its rules are being written in real time, and we are all test subjects. The investor and citizens takeaway. First, forget the 1923 playbook. The age of short, sharp, curative recessions is over, rendered obsolete by debt. Welcome to the age of long, grinding, and managed adjustments where stability is purchased with volatility. Second, monitor debt, not just rates. The trigger for the next crisis won't be the Fed funds rate hitting 7%. It will be a credit event in an overlevered corner of the system, commercial real estate, private credit, or margin loans, that forces the Fed into a fraught bailout decision, testing its new rules in crisis. Third, prepare for volatility, not a repeat. 2026 will not look like 1926's debt-free boom. It will be a new, messy amalgam, likely a stubborn mix of economic stagnation, sharp financial volatility, and persistent inflationary pressures, all carefully stewarded by a central bank on a perpetual tightrope. Historians Milton Friedman and Anna Schwartz concluded of the 1920s Fed. The system's actions were a major factor contributing to the severity of the contraction of 1929 to 33. The historians of 2124 will judge Powell's Fed not on whether it recreated 1921, but on whether its desperate avoidance of 1921 inadvertently engineered a different, perhaps more protracted, disaster. Therefore, do not invest based on simple historical analogies. Invest based on a clear-eyed understanding of the current system's binding constraints, extreme debt, shifting demographics, and the central bank's overwhelming fear of breaking them. The 1923 Playbook is a museum piece. We are all living in the first draft of the new one.